Okay. All right, everybody. So we're going to recap what we talked about last time at the end, because we're going to kind of go back over all the fun portfolio building stuff that we did as we get to the end here. But before we do that, we're going to jump into investing objectives and risk tolerance. Usually when people talk about this stuff, they talk about this before we get to the actual investments. I like to switch around the spot because it's kind of difficult to conceptualize what any of this means if you don't know what risk means on any individual security. Like if you don't even really know the difference between value and growth and T-bills and bonds and like if all of that is a mystery, it's difficult to understand and visualize what any of this is going to end up meaning when you build a portfolio anyway. So I like to start with the investments, start with the technicals. So it's like, okay, there's a lot going on, but I kind of get what each piece is, and I kind of think I understand how to maneuver through here. Then as we go here, hopefully you look at these portfolios and you go, oh, now I get why my portfolio fits into that bucket, or you understand why you might go into a different one. So advisors and investment firms use standardized terms to refer to general asset allocations and investment purposes. These will probably be familiar to you if you've ever met with a financial advisor or you've done some research on the topic. So your advisor has probably assigned you to one of these categories, but they may or may not have described its meaning to you. A lot of the time it just has to do with aligning a risk tolerance, making sure that we're following our fiduciary duties and having everything line up for you. So it's a good way to categorize the level of risk that you're taking and what you're trying to accomplish with your assets. So knowing the category of investor that you fit in makes portfolio construction way simpler, or even if you're choosing from a model or a pre-built portfolio, also makes it really easy. So even if you were just simply going to go look and say, I don't want to build this, can somebody just show me what balanced and current income, whatever looks like, it's easier to justify what you're picking and understanding the parts within it. So there's two key terms that we use to determine an investment suitability for you on a risk and objective basis, and that's objective and risk tolerance. These are kind of like the two main things that help us figure out whether an investment that we're recommending for you, or that you're being recommended by somebody else, or that you're choosing works for what you're trying to accomplish. So first of all, we have our objective, which is the purpose of the funds invested. Usually this describes the types of asset classes that end up being utilized in a portfolio. So, for example, if we're looking at a maximum growth portfolio, we just want to grow as much as possible. That's going to be comprised of mostly growth equities, maybe some value or just a bunch of different stocks, but a current income portfolio usually will have a mix of dividend stocks and bond funds, because we want things that pay income. If we're trying to generate current income this year today, we need assets that shoot out current income. Otherwise, we're not going to be meeting our objective. Risk tolerance is the amount of volatility that an investor is comfortable and able to experience. So you can think of this sort of like the emotional component, but it is also realistically at the end of the day a numerical one too, because I imagine most people can't suffer 100% losses. That's probably not going to be helpful to what you're trying to achieve, I would imagine. But I usually like to think of risk tolerance as the emotional component, because you get to look at it and go, okay, what am I trying to achieve? And when do I start freaking out? And you kind of put those together and it gives you a good idea of what your portfolio looks like. So it's important to consider the amount of risk that you're able to withstand at the same time while still meeting your financial goals. So you wouldn't want to see a 50% decline in a portfolio designed to distribute regular income for living expenses. If we're talking about something that's a little bit more discretionary or on top, you might be able to take a little bit of risk and go, shucks, I don't get to spend quite as much money this month on traveling. But if you're trying to pay for fixed living expenses, lights on, pay the bills, we probably are going to want a really conservative portfolio to not put your lifestyle at risk. So we're going to go through all the different investment objectives that we use from our firm and that you'll likely see in a lot of other firms. So starting from what would usually be the most conservative is a current income portfolio. There is also capital preservation, but it's just so far down. It's basically like a cash account. So I feel like that one's so easy to understand. I don't really feel like I need to explain that to you. But current income portfolio. This investment objective means that the investor seeks investments with emphasis on income generation. It's exactly what it sounds like. I want income currently today. I want distributions. I want cash coming out of the assets that I can spend without drawing down the principal for the most part. So they may like to have some exposure to equities, but they're primarily concerned with the preservation of capital for the most part because they want to preserve this nest egg that's going to shoot off dividends. However, usually when I create a current income portfolio, or any advisor creates a current income portfolio, you'll usually tack on some growth aspect like broad-based index funds for inflation protection. So a lot of these portfolios, while they have a primary stated objective, usually you'll have a little blend of everything to make sure that we're not just losing to purchasing power risk and stuff like that. So moving up to balanced, which in my experience, and I feel like in general experience, is probably the most common objective to land on. This investment objective means that the investor seeks investments that are generally allocated among holdings that generate income, as well as those which offer the potential for growth of the portfolio, such as stocks and stock funds. So this can be, there's a decent amount of range that can be within these objectives. So for example, you can have a balanced portfolio that's majority bonds and, you know, a healthy minority of equities, but also on the other side. So a 40-60 and a 60-40 for equities versus fixed income. I think both of those could realistically fit into a balanced portfolio, but then that's when we start looking at risk tolerance, adding that layer on top. It's like this range is where our objective could be met, but how much risk do we want to take? And you can kind of crank that up or crank that down depending on your preferences. So the investor should understand that many stocks and stock funds have an income component and are willing to utilize them to generate income. So for a lot of the time, you might have, you know, you got your 30% in growth, maybe another 30% in dividends, and then you got your other 40% in bonds. There's just a lot of ways that you can create income while still having a growth component, but then also using the stability from things like government bonds to create very predictable income over time. So moving on, we have some of the more aggressive objectives. Growth and income, I'll be honest with you, a lot of the time I just kind of roll that into balanced, because to me, balanced and growth and income are kind of two sides of the same coin. Just one of them's a little bit more conservative, one of them's a little bit more aggressive, but they end up being so similar. They're really, in terms of these definitions, when they say balanced, they mean income first, growth second, and then growth and income is growth first, income second. But growth and income, this investment objective means that the investor seeks investments that primarily focus on growth of the portfolio, with some of the portfolio being allocated to income producing investments. So if you're looking at something like, I don't know, let's say an IRA that all you're taking out is RMDs, probably this is where you're going to land. Like if you don't have lots of cash needs and all that needs to happen is you just need to generate enough income to shoot off that RMD without drawing down your growth funds, that's probably going to be where you'd land. And balanced would just be the slightly more conservative version of that. Now, moving up, we go to growth. So this is where we start getting into less and less income need. We're really not worrying about having tons of bonds or really even worrying about dividend stocks at this point. So this investment objective means that the investor seeks investments with the majority of the allocation being comprised of investments that have a focus on growth of the portfolio with little to no emphasis on producing income. So it's pretty much just what it sounds like. Lots of growth equities. We're just trying to get capital appreciation over time. We're not looking to take income out of it right now, so we'll forego dividends, we'll forego interest for the hope that it will grow further over time. Maximum growth is just you take the growth portfolio and you crank up the risk meter. That's basically it. So this investment objective means that the investor seeks investments which may consist of the entire portfolio in equities and are totally willing to invest in securities that carry a significant degree of volatility beyond traditional equity market indices. So that's where you start seeing like really volatile stuff, like if you've got a huge concentration in a tech fund, big individual stocks, that's usually going to be towards that maximum growth objective. Yeah. For the most part, I would say a growth portfolio probably starts with a maximum of like 30% bonds and then walks down. Yes, absolutely. Yeah, so it's kind of just like, yeah, for the most part, again, these are kind of two that I conflate a lot of the time because it's just kind of like, are you cranking the risk up or are you cranking it down a little bit? But these are kind of similar to me. It's like, right. Yeah, because you might have some bonds for just in case money or buying opportunities. People like doing that as well. But yeah, exactly. So, and that's kind of a great point is that's when you're fitting it into an overall picture. That's how you're able to determine the objectives where, yeah, a lot of people will just kind of go from the top down and go, I just want to be middle of the road on everything. And then they just have the same investment allocations across the board. Versus, like I talked about before, I like splitting portfolios into particular objectives. Like if I'm going to have, let's say, a client that's balanced on the overall and they have a taxable account, like just a regular brokerage, they got an IRA that maybe was a 401k rollover, and they've got a Roth IRA. I'm probably going to make the Roth IRA as growthy as possible, especially if they think maybe they won't need those assets anytime soon. Like if I can say, do you want to make this your inheritance for your kids? That's pretty great because a Roth IRA, earnings tax free. And then if I can go the most growth, take the most risk there, and we have the most time, we have the biggest chance for the biggest tax payoff at the end of the day because the beneficiaries can get the money tax free. That's why I like splitting account purposes, because it makes it really easy to earmark everything and take advantage of each account's sort of benefits.
If it's a growth fund that isn't going to be added to, hence the bonds. Right, because if you get a day like today and the market's down a lot, you can move those bonds in because you want.
Yeah, that's why even if I have a growth portfolio, I might, like, even if it's going to be almost 100% growth, I might just keep 10% just in case. Like, is there a buying opportunity? Does a certain sector just go crashing into the ground? Is there a really volatile day and I just, okay, I'll buy some of that. And it's just, it always feels nice to have some kind of mobility you can move around with. I think that's just kind of nice. So next we'll start talking about risk tolerances, and we'll have an individual slide for each of these because as it being sort of the emotional component of this whole process, the objective is really important, but the risk tolerance is almost more important because it will measure your ability to follow through with the objective. If you are not willing to stay the course for a growth portfolio, it's not going to perform as well as a growth portfolio should because you're going to make changes that are going to take you off the track. So if you determine that your risk tolerance is not high enough for a maximum growth portfolio, but you could see a growth portfolio's volatility and do just fine, you might be much better off reducing the risk a little bit and just accepting that you might miss out on a little bit of returns while still meeting the goal. The whole thing is not to do the best out of everybody. It's to meet your goals and to just make what you want to have happen. So, starting at the bottom, we have a risk tolerance of conservative. So this risk tolerance indicates that the investor is not willing to tolerate large market fluctuations and is willing to forego significant upside potential to achieve this goal. A lot of these are going to be, it's pretty self-explanatory, but it's just good to remind you of what it means. So this investor usually wants the portfolio to provide them with an income stream to meet living expenses, discretionary spending, all sorts of different stuff. Usually when you've got conservative, it's either I just don't want to see it move very much, or I want to produce income and spend it. So they're more concerned with protecting principal than growing the portfolio. This is one of those things where, sometimes it's when you have like not not so much money that you feel comfortable taking a lot of risk, but then you can also be at a point where you have so much money that you don't need to take any market risk, right? So these things can sort of sit on two ends of the spectrum. But this person is more concerned with protecting principal than growth. So an investor with a conservative risk tolerance would be most likely to choose investment objectives of current income or balanced on the low end. So you might take a balanced portfolio and go, let's not have so much growth in there. Let's bias towards value. Let's have a little bit more bonds than that. So let's start tweaking that down. Multiple objectives can fit into different risk tolerances, and that's where I start getting to, maybe I start with this portfolio that fits the objective, but then I know their risk tolerance is either over here or over here, and I can make changes to move it, and that's where that personalization starts to come in and really make a portfolio good for you. And you would also probably see somebody with a capital preservation mindset here as conservative. Moving up, we get to moderately conservative, so a little bit less conservative. This risk tolerance indicates that the investor can tolerate a bit more market risk than the conservative investor, but are still averse to large short-term fluctuations. They want to be protected somewhat from large downside market movements and are willing to not fully participate when the markets rally upwards. This is sounding, again, very much like a balanced portfolio, maybe even a more conservative growth in income. It really just kind of depends on what we're constructing. So the investor understands that the portfolio will still fall when markets decline, but want to be somewhat protected. Again, ding, 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 for me, that just sounds like balanced. That's kind of one of my favorite ones to make because you're very well diversified. So the investor with a moderately conservative risk tolerance would choose investment income objectives of current income, maybe with more of a dividend focus, maybe with more high yield, just a little bit more diversified income, or balanced, really good middle of the road, or maybe they're in the growth and income and maybe they want to have some decent growth, but they also want to stabilize that with a bunch of bond positions. Moving on, we get to right in the middle, moderate. This risk tolerance indicates that the investor is in a middle of the road category. So they want good returns and they know that they must take on more risk to get those good returns. The portfolio may hold a wide range of asset classes ranging from short-term bonds all the way to high-risk stock funds. So the investor knows that they will lose money if markets go down, but they also expect to participate in gains when the markets are performing well. So this sounds like somebody who might really start leaning towards that growth in income, or maybe even a more conservative end of that growth portfolio. So those are what they would choose. But they might even be on the balance. They might be a little bit more risky version of that balanced portfolio. So again, it's really just starting with that objective and then taking your risk tolerance and overlaying that on top and kind of seeing how much more risk am I willing to add or how much risk do I want to take away. Moving up, we get to moderately aggressive. So now we're definitely more focused on growth. We're definitely less focused on generating income, and we're willing to tolerate volatility. So this risk tolerance indicates that the investor wants to outperform the stock market indices when the market goes up. This is kind of a ridiculous description for moderately aggressive, in my opinion, but is aware of and accepts the fact that the account will likely be down more than the market indices when the stock markets perform poorly. So the investor is willing to accept more market risk than the average investor for the potential of greater returns. The investor with a moderately aggressive risk tolerance would choose investment objectives of growth and income or growth. Now, with this description up here, I pulled this from a back office thing. So, I might have some differing opinions on what they say, but that would be a growth or a max growth. And so if you're expecting to outperform stock market indices, that's where you start getting to really concentrated stuff. That's where you're getting to really, really growthy funds, concentrated sector funds, individual stocks, and things like that. Yes. Yeah. So much when you get to retirement age, it becomes so much less age-based and so much more needs-based. So it just has so much more to do with what is the actual requirement of the assets. What do we need to do here? So if I'm sitting across from somebody and if they have an investment portfolio that they're taking regular distributions from, that's the first thing I'm going to think about. I'm going to go, how can I support those distributions? Is there anything left to work with? If not, fine, don't worry about it. We're just going to give as much stability as we can for those distributions. If we can pay them just out of dividend yield, great. If we have to get a little bit of growth and do a little bit of principal sell-off, whatever, we'll work that in. But it really just comes down to, am I able to satisfy this need with a portion of the portfolio? And if there's something left over, that's when I want to start using that for inflation protection, using that for longer term growth. But I just really am more focused on the needs of the portfolio. Like, what do we...
Well, he manages two different retirement plans for me. And one is older money and it's a lump sum. And so if you're not adding to it, you can't do dollar cost averaging unless you do it internally, right? So he's got one that, for me, psychologically, that one doesn't take a lot of volatility. So it's probably looking pretty good today, but on the upside, not as much. But the 401k that I add to every month, then we're willing to be more volatile because I can always add to whatever's down and dollar cost average that out. But my view for my money is, I'm 71. The biggest fear for me would be, what if I did live too long and outlive my money, right? So in the short term, it's not too much of a problem, but he has me set up with 3 years distributions and T-bills in both plans, because I have to start them either in August of next year, or I'm going to start them probably in January. I'm going to pay some taxes and lose the use of the money, but our plan is to hire another staff member to offset that income. So in January of next year, I'll start taking the distribution, but you can look at things in stages like his lateral integration, and they have the first 2 or 3 years or 4 or 5 years, 8 years in that first 2 stages, but do have some growth because statistically you might be around to 95. Yeah, and cost of living, but cost of care, if you can imagine. Bonds that you had waiting for a buying opportunity, but we've got to save for what if we live too long. That's the biggest fear, self-funded long-term care.
So when you reach age 72, is there a strategy for withholding monthly, or do you have it withheld at the December, the end of the year?
Yeah, good point. And I misread that at 73. I'll be 72 this year.
72 or 73?
3 in the year, which it turns.
It did begin at 72 for a while, but then they put through Secure Act 2.0 and it went up to 73, and it will continue rising as life expectancy goes longer.
If you wanted to beat the system, don't withhold until December of that year, right? And so don't pay anything. You earn more money on your money, and then you write a big check to the IRS.
But that takes a special form to do that.
Well, you'd have to calculate it.
Yeah, what I'm saying is because they're going to penalize you. You're supposed to pay taxes quarterly.
Right.
You're taking that all at once. They're gonna say, hey, you're supposed to pay taxes on this every quarter. You have to file a form.
But we run into that problem. We have a lot of people taking it at the end of the year.
Yeah, you can do that.
Yeah.
Oh, yeah, you pay your estimated taxes based on what you expect to take out.
Yeah, but you gotta let them know in advance on the special form that this money came out in December. So you don't get.
But you will always know what the amount is because it won't change. Because the amount is determined as December 31st of the previous year. So all of the movement within that doesn't matter. You already have your amount determined, so you can pay your estimated based on that previously calculated amount and pull it out later.
That's not the issue. They're talking about avoiding a penalty, quarterly estimate.
Sure.
Say I'm 73 years old.
Right.
Okay. And I'm sorry I wrote this question. But really, so I'm 73. I have to start withdrawing, right? Actually, I'm supposed to start drawing from my IRA,
Mhm.
but I'm not gonna, I'm going to pay my taxes in December. In full. Well, the IRS expects you to pay quarterly estimate payments on that full balance amount. In order to not tax, because you paid it all in 1 month, they have a special form saying, showing that, hey, don't penalize me. I took this out and I paid my penalty in December, my balance in December. Or I withdrew my entire balance in December. I didn't take anything from the 1st to the 11th, okay? So they can't, you just withdraw the entire balance in December and you only pay taxes in December for that balance. So they don't penalize you for the 3 quarters, right? Do you see what I'm saying?
Well, we've had a lot of people take it in December for the prior year if they turned that in. I haven't heard any penalties, but you tell your accountant, I'm gonna be pulling this in December, and if that's true, then you pay your estimates based on every plan distribution in December.
I'm not gonna do that. I'm gonna pull it out in December.
Yeah.
Well, that's, if I pull it out in December, I don't have to pay for it. I didn't pull it out. For the last quarter.
So you're referring to a form that you inform the IRS that that's what you're.
That's what I did, and that avoids the quarterly penalties for those months you didn't pay. That's what I'm trying to,
Okay, yeah,
people understand.
They're gonna see that for the year when you actually only pull it out in December. So you're telling the IRS, look, I didn't turn this age and I didn't pull it out till December. Don't penalize me for not having that quarter. But penalties are usually based on this year, if prior years. If you have one big boom year, I usually don't, you have to catch up the next year, but whatever you have to do, you can wait till the end of the year, whatever you choose to, and have the money under your management. But I might do it in January because I want to hire somebody and start paying them with that. And then I'll readjust my withholdings relative to paying salaries. So I'm just going to spend all my money on that business, bringing in more people, expanding and keeping it going if I don't need the money because I'm working. But there's a million strategies, right? Because if I'm working, making pretty good money now, and then I get another bunch of money on top of that, I'm just giving the government 40%. But why don't I hire more young people and provide jobs, make my job easier? Because I've never taken a real vacation ever. And so now that Nash can talk to people and do things, because I usually go to, conventions, someday I'm gonna use my air miles. But so hire more people to live a higher quality of life.
I'm sorry, I brought that up. I should.
No worries. Exactly. Ask a CPA. That's always the answer. That's always the answer. All right, so as we move forward with our risk tolerances, we get to the fun ones, basically the young people risk tolerances, or the inheritance for the kids risk tolerances. Now we're looking at aggressive. Now, again, forgive me for these definitions. They're a little optimistic, if you will. This risk tolerance indicates the investor wants to substantially outperform the stock market and is willing to accept the higher degree of risk associated with seeking returns that outperform. The investor is very aware that a similar level of outperformance when markets are performing well can negatively impact them when markets are not faring well. So I guess if we want to kind of just have a realistic thought about this, it's just kind of when we compare things like a growth index fund versus a total market index. That total market index is going to capture a lot more of the market. It's going to be much more diversified, but on the upside, it's not going to go quite as far versus a growth fund might grow more over time, but there's a lot of risk associated with that. So these investors accept a high level of risk for the potential of greater returns. So the investor with an aggressive risk tolerance, I mean, come on, easy choices, growth and maximum growth. Lastly, we're talking about the one that I hope no retiree ever is speculative. And this is just one that this is when you hear about your grandson trading options on Robinhood. That's probably who this is going to be. So this risk tolerance indicates that the investor is comfortable with the highest level of risk and the highest average probability for loss of initial investment value in exchange for higher potential to profit from an anticipated price move. So the investor with a speculative risk tolerance would just choose that maximum growth. So we're talking about using derivatives to try and get magnified returns, individual stocks, super low, like options and futures and different types of strategies and all sorts of different stuff where they're just throwing stuff at the wall to hope it sticks. And for the most part, like this is not somebody that I would be advising as a client. You know, this is just somebody who's doing their own thing and they're trying to do as much as possible. Somebody, maybe a wannabe hedge fund manager or something like that. But now that we've talked about the risk tolerances and the objectives, I want to start moving on to example portfolio allocations. And it's going to be super simplistic. Okay. These are not real portfolios that I would create for a client. We're just looking at stocks versus bonds. We're just going to assume stocks mean risk on and bonds mean risk off. Even though we know that if 2022 comes around, those bonds can be a little risky. But for now, we're going to forego that, and we're going to assume that the bonds are our risk off portion and the stocks are our risk on, simply for illustration purposes. So we've got 6 different example portfolios here that basically show us different levels of risk. We've got all the way from 100% equities, all the way at the top left, down to 100% fixed income in 20% increments for both sides. So we're going to use these and a couple different examples of investors, and we're going to try and match them up together and see if we can kind of get a decent idea of what kind of super generic allocations we might use for each circumstance. So the objectives and the risk tolerance make a little bit more sense practically. So our first example, this investor is retired and his pension pays for roughly 70% of his expenses. Most expenses are covered. We just need to make up a little bit of missing income. So distributions from retirement accounts pay for the remainder. So we're good. His living expenses are paid, doesn't need anything, plus a little bit of entertainment and travel. So with this retirement account that's making up the remainder of the distributions, plus a little bit of extra spending, they desire to have some assets left over upon their passing for their beneficiaries. So we have a current income need, we're trying to generate a little bit of income, and we're also looking to have a little bit of growth for those beneficiaries later so he can leave a legacy for his family. So we have a risk tolerance of moderately conservative. He's a little bit safer. He wants to make sure that his assets are going to be there so that he can spend what he wants to spend and that it's not going to just disappear one day. And he's got an objective of growth and income. We've got that growth piece because he doesn't need a ton of income because most of his income is supported by that pension. So we have a decent amount of focus on that growth for the kids, but we also want to make sure we are generating income for that income need right now. So as of right now, his portfolio sits like this. It's got 100% stocks. It's got no bonds. It's got a beta of 1, and the standard deviation is a little bit under 15.75. So do we think that that's a suitable portfolio for this objective right now? No. No, it doesn't fit. It doesn't, based on everything that we've just talked about, this doesn't fit either the risk tolerance or the objective. So if we take our eyes back here, let's just remind you again what he looks like. Risk tolerance of moderately conservative, objective of growth and income. So we'll go back to our list of portfolios, and I'll be honest with you, there's probably more than one right answer. But what do you think, if you were looking at this situation, what kind of portfolio do you think you'd want to choose for him? 60-40? See some nods. 40-60 as well. We in agreement there? Okay. Did you say 20-80? I would be on the 60-40 train. Because we have a secondary objective of income and a primary objective of growth, we really want to make sure that we're well diversified, giving a little bit of income, because remember, such a vast majority of his income is accounted for. Now, to be fair, there's a little bit of nuance here. We don't know exactly how big the account is. We don't know exactly what the income need is and what that ratio is. But just in terms of conceptually, we know that our primary objective is growth because we're primarily looking to leave assets for the children. But we have a secondary objective of income because it is also important that his income needs are filled up, that little minority, until that time where he passes and leaves the assets. So can we make our recommended portfolio a little bit more suitable? Sure, we probably can. If the account's large enough for the income needs, we could consider a more conservative allocation. Like you mentioned, a 20-80. It's possible the portfolio could be big enough to support that, and that we're only worried about a little bit of growth for the kids, and there's more than enough money there, and we just generate tons of income. This circumstance, yes. For this super basic circumstance, yes, but really it can be whatever sorts of, yeah. So at that point, that's where you're kind of like intersecting two things, because I could say I've got a bond that pays 6% and I got a stock that pays 3%. Which one's a better income vehicle? Well, I mean, do you need any inflation protection? Is this just for the income? Like, you know, so you're starting to balance there, and then you get that more risk with the stock because you have the growth potential. So if you don't want any of that risk, you might stay with the bond and just get the yield out of it, right? Yeah, of course. But again, if this account is large enough for the income needs and it just fills everything, we got plenty of money left over for the beneficiaries, we could bring that risk allocation down for more safety. If we move on to our next example, we've got an investor in college. So their parents are paying tuition, and they've got a Roth IRA that they contributed to with money from their fast food job. They're just tucking away all their extra money. They're being a really good kid, putting all of it into their Roth IRA, making us really proud. So they've got a risk tolerance of aggressive and an objective of maximum growth, because they're not going to touch this money for a really long time. This is what I would call the accumulation stage. They're on the way up. They can take the risk because every single time they put dollars in their account, if the stock market is down, they buy more shares. And if it's going up, they continue participating in that trend. So we have that risk tolerance of aggressive. We have that objective of maximum growth. So we want to make sure that they are taking on that volatility for the long term, because they're probably not going to pull anything out of this. Hopefully, we would assume they also have a nice little emergency fund, and you know, they've got mommy and daddy nearby to help them out if anything happens, so they don't have to tap into this. So her current portfolio sits at a 60-40 allocation. We've got this balanced 60% stocks, 40% bonds, beta of roughly 0.65, standard deviation a little bit under 10%. So do we think this is suitable for her needs? I'm seeing some head shakes. And honestly, yeah, I would totally agree with you. So based on her objectives, which of these do we think we'd pick for her? First one, 100% equities. We good with that? All S&P 500? I would be, because there's no need. There's no income need currently. That retirement, that qualifying age is so far out in the future. If this person is 21, 22, 23, we've got over 25 years of growth before she even qualifies to start taking out the earnings tax-free. So that's a really important thing. That time horizon, we can stretch that really far. So we get to this portfolio with a beta of 1, standard deviation just under 15.75. Our objective is max growth. The investor is not expecting to utilize the funds for at least a few decades. And again, like I mentioned, this is provided they have adequate emergency funds and health insurance. If you don't have that, then you need a cash reserve. You need to have a more balanced approach because you need to be able to support short-term emergencies. One thing that is very nice about a Roth IRA in that circumstance is if you're still building up an emergency fund, but you want to take up as much of the annual contributions as possible, contributions can still come right back out of a Roth IRA. Unlike a traditional IRA, with a Roth IRA, you put money in, you can take your contributions right back out. You can't bring any earnings with it, or else you start paying penalties, but you can take your contributions right back out. So if you want to say, okay, I need a couple $1,000s as my emergency fund, but I want to try and get as much money in my Roth IRA right now, take advantage of every single year's max contribution. You could stick it in there, throw it in a money market fund, and if you have a need for it, you can still withdraw it and use it as cash. No worries. So that's a little fun thing. You can kind of combine that until you start getting excess income to fill up an emergency fund outside. Then you invest it all and don't worry about it. So moving on to our third example. Now we've got an investor that's currently looking for a new home. Oh, this might sound a little familiar from several classes ago. And he saved $100,000 as a down payment on the mortgage. He expects to find and close on a new house in the next year. So 1-year time horizon, and he's deposited the cash into a brokerage account for the time being. He's got a risk tolerance of conservative and an objective of capital preservation. This should be pretty easy. Current portfolio looks like 20% stocks, 80% bonds, beta about 0.3, standard deviation just over 5.3%. Now I'm curious what the answers will be here. Do we think this is pretty suitable for this? Saved $100,000 as a down payment, and he puts that into his brokerage account in anticipation for any year using it for the mortgage. Yeah. No, he put it in the brokerage account. So it's sitting in that brokerage account. So how suitable do we think this is for that need? 1-year time horizon. We got 1 year until we're ready to spend. I see a head shaking. Think it might be okay? A little conservative? Well, if we're looking at these, well, remember, this is going to go straight to that mortgage. There's no other money that he's going to pull from. This is the down payment. For this objective, we're not worried about anything else. Well, right now, the brokerage account is just $100,000. Right. So if we're going to pick from this list, we're going to pick the most conservative. Now, again, forgive me, this is a bond aggregate fund. It's not fully representative of what I would use for this actual use case. But assuming that the bonds are risk off, we need to be totally risk off because we've only got 1 year. The only thing I'm really ready to do is get a little bit of yield for our time there. Now in this scenario, our standard deviation is still 4.68. It's interesting how when you take out the 20% equities, the standard deviation doesn't actually go down all that much because they're a little bit uncorrelated. Anyway, that's a fun investment. But we have a short time horizon and a low risk tolerance. Now, how can we make the recommended portfolio more suitable? So because of our time horizon being really short, super compressed, we would focus on ultra short-term government securities or money market funds or a cash deposit program at the brokerage account or really ultra short munis, whatever makes the most sense. But I would be saying get that duration risk all the way down. Make sure that duration risk at least matches the time horizon, if not shorter. So if I've only got a year, I don't want my duration to really be much higher than 1 year because I want it to be nice and crunched down so that volatility is not too bad because I don't want to be, in the year where you get 0.25% increase, 0.25% increase, 0.25% increase, and the bonds drop in value a ton. I want to be protected against that because this really needs to be my cash. So, a couple factors that could impact objectives and risk tolerance. So if there's substantial change in assets, time horizon, or cash needs, it is likely that our objectives and risk tolerance could change as well. So really all that I'm saying here is just when stuff happens, consider it as in the totality of the plan. It's really important to see everything in the big picture and how it all fits in. So all of these factors directly impact the objective by changing the scope of the investment strategy. More time means more acceptable risk. Greater cash needs require more stability. It's really just balancing those two things, time and liquidity need. So if I get into a circumstance where I need a sudden cash need, for example, I'm sitting on a 60-40 portfolio, nice and balanced. Now 20% of the portfolio needs to be liquidated in the next year because, as you can see, our home is a little worse for wear. A little storm came through and made things not so great for us. So liquidating half of the current bond allocation, take that 20% from that 40%, now pushes the portfolio into extra risk territory. We get into a point where now, instead of it being a 60-40, it's proportionally closer to a growth portfolio. It's less balanced, it might be too risky. So what I generally would do is I would be anticipating this distribution, reallocating the portfolio so that I take this 20%, I stick it in cash across, then looking at the rest of the portfolio, forgetting that that cash even exists, get it back to my 60-40, and then push out that cash allocation to fund the distribution. So it's just kind of understanding that as these things change, as distributions happen, as money comes in or out, it's important to understand how that changes the nature of the portfolio so that we're still in line with what we're trying to achieve in the long term. Receiving a substantial pension. Now, usually you're not going to get a surprise pension in your retirement, but some people don't really consider it as an investment asset sometimes. So let's say we're looking at a 60-40 retirement portfolio. We come up to and we are retiring and we go, wow, that pension is really fantastic. I didn't think it was going to be that big. Maybe you just didn't talk to your company for a while and you got surprised. Anyway, distributions are no longer required from your retirement portfolio, 401k, IRA, whatever you got. They're not even needed to fund retirement expenses due to a sizable pension. So one thing that you can do, one thing that we usually do, we do this for both pensions and Social Security, is you can kind of go, let's imagine that the money coming in every month or every year is the yield off of a government bond, because we're pretty certain that this is going to continue for the rest of our life. We have pretty solid ideas that that income will stay there, so we can consider it like a really high grade bond. And I can think of that as, okay, so what amount is this maybe 3 or 4% of, whatever's comparable to yields in the market right now? So if you were looking at a pension, you go, this seems like about 4% of $500,000. Congratulations. You can now say that you've got a $500,000 bond allocation within your investment portfolio. And now you can say, oh, maybe I can be a little bit more aggressive with my funds, because now you're creating a more balanced picture overall. So the present value of that pension can be imagined like a large government bond position. So if you use something like a financial calculator, plop in a couple numbers, you say it's about, I want to consider it to be 4% yield or 5% or 3%, whatever you feel like. You can kind of get a rough idea of what dollar amount does that income represent in assets, and then you can figure out how to allocate more properly. So the pension begins serving as our bond allocation. So the objective of the investment account changes from that balance to maybe growth, maybe even max growth. If you got to take RMDs, yeah, stick a couple percent over there to cover in bonds to cover the distributions. But if you don't need that income anymore and you can stomach the risk, if your risk tolerance allows, you can change your objective to fit that so that you're looking at the broad scope of everything, not just your investment account in isolation. So that's going to be really important if you're doing that, you obviously don't want to increase your risk too much, because you do still want to be able to fund that. So that's where I would be kind of considering that as a future income need in a way, where I would say, let's just assume that I'm probably going to have to pay this later. how would I need to invest for that if I'm assuming that that's going to happen? So that's kind of how I would think about it, is it's an income need, but in a different way for a more specific purpose rather than living expenses. Retiring earlier than expected can also be something that makes you change your needs. So let's say you're sitting on that 60-40 portfolio again. You become disabled 10 years ahead of your planned retirement date and need to suddenly retire early. Social Security is not going to cover your living expenses, and the portfolio was not large enough to suffer from substantial equity losses and continue paying sufficient income. So I think that we're riding on that line where the yield in our portfolio is just about enough to pay off our living expenses and make sure that we're doing okay. But then if the market crashes by 30%, we might not get the same sort of yield. We might not have the same sort of assets to pay that off. So we need to make sure that we tone down our risk, that we get our yield from more stable places, and our objective may change from growth in income down to current income, because it's really important that we satisfy the current income need today and don't take on too much risk to basically risk the loss of that income, because if you got living expenses, you got to pay the living expenses. No ifs, ands, or buts about it. So it's important to rebalance the portfolio down to majority bonds and dividend paying equities to make sure that we have a little bit more of a stable income stream for that. So now that we've gotten through all those things, we're going to go back and we're going to recap a lot of what we learned about portfolio building. So if you have questions about portfolio building, asset selection, any of the fun stuff, within this would be your time to ask, please, all questions. I'm ready for them. So remember the two components that we use to build portfolios. First of all, being lateral integration, looking at our time and objective-based allocations, thinking about what are we doing in the short term, what are we doing in the immediate term, what are we doing in the long term, and how are we serving those needs. Using vertical integration to diversify among types of asset classes and mitigate our unsystematic risk, any of those unique, idiosyncratic, all those fun words. Make sure that we're not taking on any specific risk too much. And we're not necessarily aiming for the best nominal returns. We're not looking for the highest number, but we want the best likelihood of success given the stated goals for the portfolio. It's much more important to succeed in fulfilling your goal than it is to beat your neighbor with your stock returns next year. It always is going to be. So remember, an investment account can be part of an overall portfolio, and it can be evaluated on its own. How it fits into your overall picture is up to you. If you like to say, my general risk tolerance is this, apply it the same way across all accounts, totally fine. If you like to split it up like I do and say, this account is my growth account, this account is my income account, this account is my cash savings, this, all those different things, that's how I personally like to do it, because it makes it really easy to earmark everything and stomach volatility in the accounts that are meant for volatility. That sort of separation in the mind, for me, makes it a lot easier to stomach risk. So remember what it looks like for us to do our lateral and vertical integration. We're using our different stages to stage out our asset needs. Stage 1, short term. Next couple years, like if you've got RMDs and you like to feel really safe, you could stick 3 years of RMDs in a short-term treasury bond fund. You're going to do great. You'll always have your money to distribute them out. Stage 2, looking for a little bit of participation in that market, relatively low volatility, diversified asset classes. Stage 3, looking for those stock market indices, more growth-oriented stuff, whatever you're doing for the long term. And then with your vertical integration or diversification, starting with super low cost index funds. Keep that cost super low. Remember, fees are usually the number one detractor of returns. If you're paying 1.5% for a growth fund, I don't know what to tell you. You can get so many growth index funds for a couple basis points, costs almost nothing, you'll never notice it. Moving up to level 2, that's where you can start to get maybe some factor funds, things that fit your values a little bit more. Great place to find some inexpensive ESG funds, any sort of social investments like that. That's always wonderful. Moving up to level 3 is when you start to See if there's a fund manager you want to try out. See if a T. Rowe Price or Cohen & Steers manager can do something good for you. Any of those big names, that's a great opportunity to put in some active management if you feel like you need it or you want to try it out. So again, sort of just visually representing that in each stage, how we're diversifying each time-based allocation of our portfolio. And remembering that if you want to, you could just do the very bottom layer, broad-based, low-cost index funds. You're going to do just fine. As long as you are allocating for your needs, you're taking on the right amount of risk. If you're just buying the super cheap index funds to fulfill it, you're going to do just fine. You're going to do great. I just like having all that different layers of diversification, particularly if I have an account that I'm adding to, because it gives me a lot of opportunities to pick stuff that's not doing well or things that are down. But a lot of the times, if you really want to keep it simple, stay in stage one, total market index funds, bond index funds, just super cheap index funds. You could probably build an entire portfolio with funds that cost less than 1/10 of 1% and pay almost nothing in those management fees. And that would be a great portfolio. So remember the different types of risk that we're managing against, that we're diversifying away. Remember that systematic is non-diversifiable. We can't get rid of systematic, but we can manage how much we're exposed to it simply on an amount basis. So if we have our purchasing power risk, really that's our risk of not being invested at all. If our money is not growing at all, it's losing to inflation. So we want to always make sure that we're fighting against that. Reinvestment rate risk. What kind of risk are you taking by exiting out of a position that was returning this much? Or like really, for example, you're in a long-term bond, or say you're in a short-term bond, the long-term bond locks in the same rate, and then your bond expires. You go back out into the marketplace, but interest rates have dropped a little bit. So now you're going into a lower interest rate. So if you've got a really good rate on a long-term bond that you feel comfortable about, and you want to lock in that rate, maybe consider it. Interest rate risk. Remember, that's represented by duration. It's the amount of risk that we take on. Basically, for the longer the maturity of the bonds are in our portfolio, the more the current value will swing up and down as interest rates change in the market. Because, again, if you hold a 5% bond and they can get 10% out there in the marketplace, well, they're not going to pay you the same par value for a 5% bond. They're going to want to pay you half so that the 5% they receive from your bond feels like the 10% that they would get out in the marketplace. So that's why those bond values can change a lot. Market risk. Risk of being in the market. It's just the volatility that you're going to feel over time with things change in the economy, when things change overall. Market risk is just the risk you can't get away from if you want to be invested at all. And then exchange rate risk, being in different countries. Obviously, you're always going to have that risk of currencies changing in value a little bit. But as long as you're diversified and invested for your goals, it really shouldn't be that big of a problem. So we can't diversify these risks away, but we can manage them, again, by how much market risk am I willing to take on, how much S&P 500 am I going to be holding, how much cash am I going to have, but how much does that increase my purchasing power risk? All of that within systematic risk is just a balance. Where do you want to land? What is your biggest concern? How are you addressing that? And then as we move on to unsystematic risk, or diversifiable risk, remember this is the type of risk that we're almost completely getting rid of by being incredibly well diversified. All of those accounting, business, executive, financial risk, all of those things that have to do with a company and how well that company does and whether they survive or not. We diversify that away by having so many freaking companies that if one disappears and falls off the S&P 500 index, we didn't even really notice because we weren't paying attention to it so closely because it's not a big part of our portfolio. A great opportunity to understand how much unsystematic risk you're taking on is by looking at the similarity of holdings between the different funds in your portfolio. You'd be surprised. You might be like, I've got this stock fund over here and that one over there, and I've got this growth fund and this S&P fund. I'm so diversified, but 7% of your portfolio ends up being Apple because it's always the top holding in a lot of these similar funds. So it's always good to check. If you've got a bunch of funds and you go, these seem suspiciously similar, take a look at their underlying holdings, particularly the top 10, and see kind of, how much of those individual companies are you actually exposed to. And if you've got a whole bunch of tech exposure, you might use something like sector funds to get everything else around it and sort of pull that risk off. So obviously we got our country risk too. If you're going to invest in internationals and you don't want to be super risky to China, just include some Europe in your portfolios. A lot of really good international funds are really well diversified, getting both developed markets and emerging markets, but those are performing quite well right now, those international funds, in comparison to the US stock market. So that's another reason to have a decent amount of internationals, is for times like this. It's not because you get all those things and they're going to perform better than the US market, but there are going to be times when the US market has a very particular thing going on, like right now, where the US market large cap growth is down 10%, but international equities are up almost a similar amount. So it's really having that non-correlated or sometimes inversely correlated return, where when you have one asset drop a lot, one asset up a decent amount, it kind of brings it back together, levels it out, and your risk actually goes down a little bit, because even if they have similar levels of risk, but in different directions, it actually can bring down the short-term risk of your portfolio. Things like default risk, just make sure you're not investing in super low-grade bonds all the time. Get a lot of government bonds in there. They're still paying awesome yields, so take advantage of that. If you want a little bit of extra yield, just understand that that's the risk you're taking on. Government and regulatory risk, a lot of this just has to do with being over-concentrated in sectors. For example, in technology, these tariffs can be a little scary for tech companies that import from some of these countries, because now if they're unable to import super cost-effective manufacturing and chips and all this kind of stuff, that just gives a huge hit to their earnings potential. So making sure that you're in a whole bunch of different sectors of the economy that are not going to all just be crunched by one regulatory move, that's something to think about and is particularly pertinent today. So again, kind of reminding you about these vertical integration, just kind of an example of how I do it. A lot of your total market low cost index funds, you got super cheap options. I think Fidelity has a total market for 1.5 basis points. S&P funds cost 2 or 3 basis points these days. Bond funds are usually pretty cheap too if you get the index funds. I think iShares was like 9 or something like that. Moving up, you might put in some of your sector funds, factor funds, other passively managed funds, or like gentle active, like inexpensive active management for the most part. Because some of these factor funds are like technically passively managed, but they're really just gently active management. Anyway, that's a complex conversation for an ETF conference like we were just at. But then moving up, you might have your more actively managed funds, your more expensive funds up at the top, but making sure that those are smaller portions so that most of your portfolio is really biased towards low cost. Because again, we don't want to just hand over returns, especially if they're not beating their comparable index. Why do I want to hand them 0.5% year over year if they're not even doing anything for me? So that's why I really bias towards the low cost, so that I can keep that market return for myself and use it in my portfolio and in my plan. And then again, you've got your super basic allocation guideline. Remember, this for the most part will land you at a balanced portfolio, just kind of by accident a lot of the time. So you can take these and then you can go, I don't have so much of a cash need. Let me bring that down to 10% or 20%, whatever's comfortable. Maybe I have a way bigger tolerance for growth. Kick up that stage 3 allocation a lot more. Or I really like that middle ground. Let's put most of it in stage 2. And then making sure that you have a nice bias towards that bottom layer. Those numbers should be reversed. Making sure you allocate a lot of that percentage towards low cost investments and a very little bit towards the managed funds at the top. Yes. Yeah, those numbers are backwards. I got to fix those. Those are reverse order. Remember, we made our balanced portfolio a little while ago. This is what that ended up looking like. And we can just kind of see the representation of that, where we've got these index funds down at the bottom, where this is a balanced fund, but it's like, it's two indexes put together into one fund. We've got our short-term treasury, 0 to 3 month treasury index fund over there. We've got a S&P index fund, and then we've got our international without US. We've got some minimal volatility, so your factor funds. You've got some corporate debt, actively managed stuff, and really just getting nice, good representations of each of those categories and what they might look like in the market. And remember, this isn't a specific recommendation. This is probably not the portfolio I'd build for you or I'd put you in, but it just kind of gives you an idea, like if you're looking at each of those sections, what does that fund look like? What are some of the characteristics? What is kind of similar to it, so that if you see something that reminds you of one of these, you might have a better idea of where you're going to slot it in for your portfolio. And then we talked about evaluating investments with Morningstar and how we can use that, how that's where we're going to find a lot of the statistics and risk measurements that we're talking about, that we can use to measure the suitability of each asset or our portfolio as a whole. So Morningstar provides really comprehensive, in-depth look at investment products to help us choose assets for our portfolios. And I use it all the time. It's something we've used for decades now. It's a very, very, very big name in the investment space, and they do a lot of really good stuff. So there's a lot of metrics we can use to evaluate both individual assets and investment portfolios. And if you remember, a couple of those are beta, alpha, and R squared. Super quick reminder, beta is a relative measurement of volatility, or the systematic or market risk of a security or portfolio compared to the market as a whole, usually with the S&P 500 as our benchmark. And the alpha refers to the excess returns on an investment above the benchmark return when you adjust for risk. So when you look at that benchmark and go, how much of that market risk am I taking, using beta as that measurement? Okay, so how much did I earn relative to that? If I took half the risk and I got half the return, okay, great. Then if you get a little bit of extra on top of that, that's where your alpha starts coming from. And then also, of course, the risk-free rate and all that fun stuff, but I don't want to bore you with math. R squared, percentage of a fund's securities price movements that can be explained by movements in a benchmark index. Again, this can be helpful if you're looking at growth funds or any really sort of managed fund and you're comparing it to an index and say, how much of those returns are explained by what's happening over here? So if you're looking at a factor fund, maybe you're seeing much better returns in the factor fund, but it still has a high R squared. That just means that it just took its returns from the index and it got rid of the bad performers. So there's kind of, R squared is a really interesting thing to use to think, so how much of those returns were explained by what happened over there? And maybe it can help you determine whether a manager is actually doing anything or not. And then again, we have our non-relative risk and return metrics. So these are just totally in isolation. We're not really worried about comparing it to the S&P 500, comparing it to the bond aggregate. This is really just, we're looking at a security or a portfolio completely in isolation. So we've got our mean return, which is really just the expected average return based on all of the data that we've got in this investment or portfolio, all of the historical data. If we just had to make an expected projection based on all the historical data, what do we think it's going to be? So it's not using, economic factors and all that sort of stuff, just statistical analysis of the previous returns. And then when using that mean return, our standard deviation is basically the channel around that return that we're most likely to see the most of our returns in. Remember, they can really land outside of that. There are multiple standard deviations. Pretty much all returns land within 3, a really strong amount within 2, and a decent majority within 1. And then obviously you have your outliers. But we're really just measuring around that mean return. How far do we expect to go? So if we've got S&P averages 10% a year and its standard deviation is 15, you can be pretty confident that for the most part, on average, years will be anywhere from a -5% return to a 25% return. Just kind of within that band is what you can usually expect on an annual basis. But again, averages are determined by outliers and all sorts of different numbers all being averaged together. So don't ever have an expectation that you can guarantee where your return will be based on mean return or standard deviation. And your Sharpe ratio, basically just like alpha, but instead of using beta to measure risk, we use standard deviation to measure risk. So we just see based on the standard deviation, if we got an outlier year, it's going to look like it has a good Sharpe ratio. If you get a lot of outlier years, that Sharpe ratio goes up over time. Then we get to our bond-related metrics, where we've got our average effective maturity, which is basically just the weighted average of all the maturities of the bonds, considering things like mortgage prepayments, puts, adjustable coupons. So if interest rates can change on those bonds, if they can be called away early and say, I want to buy this bond back, I want to stop paying interest. That can happen if there's a call or a put on the bond, just like a stock option. And then you've got your average effective duration, which to me is the more important number because this measures our interest rate sensitivity. So we're basically using the coupon rate or the yield to maturity, interest rate, all that fun stuff. We're calculating that together with the maturity, and we're basically using the interest to shorten the maturity down to what becomes the duration. And really, I like to think of the duration as sort of the payback period. So if I've got a 30-year bond and I'm being paid a whole bunch of interest, each interest payment to me is chopping off a couple days of how long technically it would mathematically take for me to get paid back. And then that's basically what duration is. But most importantly, it's your interest rate sensitivity. So if you got a really high duration, if interest rates go up or down, you should expect some volatility in your bond funds. Then, of course, we've got our credit rating. So we gave out a handout on this last time, I think, sent out an email and all that kind of stuff. But really, everything above your triple Bs and above is considered investment grade, which is pretty good. Not super high volatility, but also not super high interest rates. Everything double B and below is considered junk or high yield. So you'll get definitely higher interest rates, but you will also be taking on greater default risk. Now, over long periods of time, diversified high yield bond funds do pretty well, as do total market bond funds. So just kind of consider what you're trying to do. If you've got some extra time and you still want to consider bonds, maybe high yield makes sense. But if you're trying to pay current income needs, stay in that investment grade half up there. That's definitely where I would be. So that was a lot of information. That was a lot of information for building portfolios. So I just want to open up and just, if anybody's got any questions on any of the specifics there, even if you've got questions on funds and you want to hear just anything about the portfolio construction, asset selection process, we got any questions there? Yes.
Dividend producing stocks. Obviously, you want the dividend. But should there be no growth at all, or should we still have some growth?
Yeah, so for the most part, they're usually going to have some growth. And if they don't have any growth at all, usually I'd be a little, I'd be a little worried. But it really just kind of depends on what you're looking for. For the most part, I mean, you'll have really high dividend stocks that don't have a lot of growth because they just are kicking out so much earnings. Now, for the most part, I see most of your kind of good dividend paying stocks and funds maybe are between 2 and 3% yield, where they're still getting some decent growth over time. But that's again where I would just be looking at things like inexpensive index funds, like a large cap value fund or a large cap dividend fund. I can show a couple examples of that, but that's where I would just want to be diversifying into high quality stuff like that, quality factor funds, all sorts of things. Yeah. Anything else?